EP Capital presents Deep Dive on Adani Green Energy. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your AI host, Rutvik. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today, we are going to talk about Adani Green Energy. Whether you're a value investor, growth seeker, or someone curious about India's green energy revolution, this analysis will give you everything you need to know about AGEL. But before we begin, let me remind you that this is purely educational content and not financial advice. Always do your own research and consult with financial advisors before making investment decisions. Introduction: Why Adani Green Energy matters. Imagine a company that went from zero to becoming India's largest renewable energy company in less than a decade. That's Adani Green Energy for you. With over 15.8 gigawatts of operational capacity and ambitious plans to reach 50 gigawatts by 2030, AGEL isn't just riding the green energy wave, it's creating it. But here's the million-dollar question. Is this renewable energy giant a golden opportunity or a potential value trap? Today, we'll dissect every aspect of this stock, from its financials to its controversies, to help you make an informed decision. The company and its promoters. Let's start with the basics. Adani Green Energy Limited was incorporated in January 2015 as part of the massive Adani Group conglomerate. The company is headquartered in Ahmedabad and operates as India's largest pure-play renewable energy company. Who's running the show? The leadership structure is dominated by the Adani family. Gautam Adani serves as the non-executive chairman, while his nephew Sagar Adani holds the position of executive director. The day-to-day operations are managed by Vineet Jain as managing director and CEO, with Ashish Khanna serving as the chief executive officer. This family-controlled structure is typical of Indian business conglomerates, but it does raise questions about corporate governance that we'll address later. The company has a relatively new management team, with many key positions filled by executives with less than a year of tenure. The business model. AGEL operates a straightforward but capital-intensive business model. The company bids in renewable energy auctions conducted by government agencies, then develops, constructs, and operates solar, wind, and hybrid power projects. Most of their generated power is sold through fixed tariff power purchase agreements, spanning 25 years, providing predictable cash flows. As of 2025, the company operates solar power plants with 10,103 megawatts of capacity, wind power plants with 2,000 megawatts, and hybrid plants with 2,140 megawatts. This diversified renewable portfolio positions them well for India's ambitious target of 500 gigawatts of renewable capacity by 2030. 10-year financial analysis. The numbers don't lie. Now let's dive into the meat of our analysis. The financials. This is where we separate the wheat from the chaff. Revenue growth. A rocket ship trajectory. The revenue story of Adani Green Energy is nothing short of spectacular. From a modest Rs 31.3 billion in fiscal 2021, revenues exploded to Rs 112.1 billion in fiscal 2025. That's a compound annual growth rate of 35.6% over the past 5 years. Breaking this down further, the company reported Rs 3,312 crores in Q1 FY26, representing a 31% year-over-year increase. Energy sales increased by a whopping 42% year-over-year to 10,479 million units in the same quarter. Profitability, the margin story. Here's where things get interesting. Net profit margins have been consistently improving. In FY25, the company achieved a net profit margin of 17.8%, up from 13.7% in FY24. The net profit itself jumped 58.8% from Rs 12.6 billion in FY24 to Rs 20.0 billion in FY25. Over the past 5 years, net profit has grown at an astronomical CAGR of 82.1%. In simple terms, if you had Rs 100 of profit in 2020, it would be worth over Rs $1,000 today. That's the power of compounding in a high-growth business. The company maintains industry-leading EBITDA margins of around 92.8%, which essentially means that for every rupee of revenue, about 93 pays flows directly to covering debt service and generating returns. The debt reality check now for the sobering part. Debt levels. This is a capital-intensive business, and the numbers reflect that reality. Total debt stands at $800.4 billion as of March 2025, giving the company a debt-to-equity ratio of 354.6%. To put this in perspective, for every rupee of shareholder equity, the company owes Rs 3.55 to creditors. The net debt increased from Rs 469.56 billion in March 2024 to Rs 728.29 billion in March 2025. However, here's the crucial context. Most of this debt is secured by long-term power purchase agreements with government entities, providing predictable cash flows to service the debt. The interest coverage ratio of 1.4 times, while low, is not uncommon in the infrastructure sector. Cash flow. The lifeblood. Operating cash flows have been consistently positive and growing, reaching Rs 83.6 billion in FY25 from Rs 77.1 billion in FY24. This demonstrates the company's ability to generate cash from its operations, which is crucial for a capital-intensive business. However, free cash flows remain negative due to massive capital expenditures for new projects. This is typical for a rapidly expanding infrastructure company, but it means the company relies on external financing for growth. Technical analysis. What the charts tell us. Moving to the technical picture, Adani Green Energy's stock chart tells a story of both spectacular gains and volatile corrections. The big picture. The stock has delivered phenomenal long-term returns, with a 10-year price total return of 2,895.9%. However, the journey hasn't been smooth. The stock hit an all-time high of Rs $3,050 in April 2022, before experiencing significant corrections. Current technical levels. As of our analysis, the stock is trading around R980, showing the following technical indicators. RSI, 14-day, 57.92, indicating neutral momentum. Moving averages. The stock is trading above most short-term moving averages, suggesting bullish bias. Support levels. Key support around Rs 935-950 range. Resistance levels. Immediate resistance at Rs 1000-1020 range. The technical rating shows a strong buy signal from moving averages, while oscillators remain neutral. This suggests the stock is in a consolidation phase with a slight bullish bias. Volatility profile. The stock exhibits high volatility with a beta of 0.82, meaning it's slightly less volatile than the broader market. The 52-week range spans from Rs 758 to Rs 2091, highlighting the significant price swings investors should expect. Benjamin Graham. Valuation, the value investor's perspective. Now let's apply Benjamin Graham's conservative valuation principles to see if AGIL passes the value investing test. Graham number analysis. The Graham number for Adani Green Energy stands at approximately R129.41. With the current stock price around R980, this gives us a price-to-Graham number ratio of about 7.6. According to Graham's conservative approach, any stock trading above its Graham number is considered overvalued. AGL is trading at nearly 8 times its Graham number, suggesting significant overvaluation from a pure value investing standpoint. Historical context. Over the past 10 years, AGIL's price-to-Graham number ratio has ranged from a low of 6.79 to a high of 58.75, with a median of 18.41. The current ratio of 7.6 is actually near the historical low, which could be interpreted as relatively attractive compared to its own historical valuations. The growth factor. Here's the critical caveat. Graham's methodology doesn't account for growth, and AGIL is clearly a high-growth company. The formula punishes companies with high growth rates and capital intensity. For a company growing revenues at 35% annually, traditional value metrics may not capture the full picture. Pros versus cons, the bull and bear cases. Let me present both sides of the investment thesis objectively. The bull case, why investors are excited. First, India's renewable energy opportunity is massive. The government aims to achieve 500 GW of renewable capacity by 2030, and AGIL is perfectly positioned to capture this growth. With current capacity of 15.8 GW and plans to reach 50 GW by 2030, the company could potentially triple in size. Second, the business model provides excellent revenue visibility. With 25-year power purchase agreements with government entities, about 85% of revenues are locked in, providing predictable cash flows. Third, operational efficiency is industry-leading. EBITDA margins of over 90% are exceptional by any standards, and the company continues to benefit from falling solar and wind technology costs. Fourth, management's execution track record is impressive. The company has consistently met capacity addition targets and has successfully raised capital for expansion. According to Macquarie Research, the bull case scenario could see the stock reaching R2600, implying a 200% upside if the company achieves its 50 GW target. The bear case, the risks you can't ignore. However, there are significant concerns that potential investors must consider. The most obvious is the massive debt burden. With debt to equity of 354%, the company is highly leveraged, making it vulnerable to interest rate changes and refinancing risks. Execution risk is substantial. Scaling from 15.8 GW to 50 GW requires flawless project execution, regulatory approvals, and land acquisition, all of which can face delays. The company's dependence on government policy creates regulatory risk. Changes in renewable energy policies, tariff structures, or subsidy mechanisms could impact profitability. Competition is intensifying as more players enter the renewable energy space, potentially pressuring margins and market share. Finally, the stock's valuation appears stretched by traditional metrics, leaving little room for error in execution. Important checks, controversies, and global position. We cannot discuss Adani Green Energy without addressing the elephant in the room, the Hindenburg research controversy. The Hindenburg allegations. In January 2023, Hindenburg Research published a scathing report accusing the Adani Group of brazen stock manipulation and accounting fraud scheme over the course of decades. The report alleged the use of shell companies in offshore jurisdictions to manipulate stock prices and inflate revenues. Following the report, Adani Group companies lost approximately $150 billion in market value, though they have since recovered significantly. Gautam Adani's personal net worth dropped from being the world's third richest person to outside the top 30. Current status. It's worth noting that Hindenburg Research announced its closure in January 2025, with founder Nate Anderson disbanding the firm. However, the allegations have led to ongoing investigations by Indian regulators. The Adani Group has consistently denied all allegations and has received backing from several international investors, including Abu Dhabi's International Holding Company and U.S. investment firm GQG Partners. Global market position. From a competitive standpoint, Adani Green Energy has established itself as a significant player not just in India, but globally. The company ranks among the world's largest renewable energy companies by capacity and has expansion plans in international markets. The company's ESG credentials are strong, ranking first in the FTSE Russell ESG score in the alternative electricity subsector globally. This positioning is crucial as global investors increasingly focus on sustainable investments. Investment verdict: balancing risk and reward. After analyzing all aspects of Adani Green Energy, here's my balanced assessment. For growth investors, AGL offers compelling exposure to India's renewable energy boom. The company's track record of execution, massive addressable market, and government policy support make it an attractive growth play. However, be prepared for high volatility and execution risks. For value investors, the stock fails traditional value metrics spectacularly. Trading at 7.6 times Graham number and with high debt levels, it doesn't fit the conservative value investing framework. However, if you believe in the growth story, current levels might seem reasonable compared to historical valuations. For income investors, this isn't your stock. Eagle pays no dividends, focusing entirely on reinvesting profits for growth. Risk considerations. The high debt levels, regulatory dependencies, and execution risks make this suitable only for investors with high risk tolerance. The Hindenburg controversy, while not proven, adds an additional layer of uncertainty. Conclusion. Adani Green Energy represents both the promise and perils of investing in India's renewable energy transition. The company operates in a massive growth market with strong government support, has demonstrated excellent operational efficiency, and possesses a clear competitive advantage. However, the high debt levels, stretched valuations, and execution risks cannot be ignored. The Hindenburg allegations, while unproven, highlight the importance of corporate governance concerns. My take? AGL is not a stock for conservative investors or those seeking steady returns. It's a high-risk, high-reward play suitable for growth-oriented investors who believe in India's renewable energy story and are comfortable with significant volatility. If you do decide to invest, consider it as part of a diversified portfolio and be prepared for a bumpy ride. The company's success largely depends on flawless execution of its ambitious expansion plans in a highly competitive and regulated environment. Remember, successful investing isn't just about picking winners. It's about managing risks and ensuring your investments align with your financial goals and risk tolerance. Disclaimer: this analysis is for educational purposes only and should not be considered as financial advice. Stock investments carry inherent risks, and past performance doesn't guarantee future results. Always consult with qualified financial advisors and conduct your own research before making investment decisions. The views expressed are based on publicly available information and current market conditions, which can change rapidly. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor.